What if this is no longer a valid tip in 6 months because the conditions and the way that our U.S. government and the FOMC is able to make choices? There's some discussion about Jerome Powell right now. I mean, this could be null and void in, 1 week, this concept and skill. So I would say never take anything as a holy grail opportunity and just show up for the work of whatever you want to do and stay fluid with the market conditions and what works now, and knowing that it worked for the past year, maybe it won't work for the year moving forward. So just stay present, I think, and flexible with what you are doing and how you are learning, and not too certain on anything, because then that keeps you safe.
Just a quick pause before we get into this. Trading can be intense, and staying mindful during your session matters so much. That's why I created and am sharing a free 3-part audio experience that's helped me deeply. 1 for starting your day with calm intention, 1 to stay centered while you trade, and 1 to wind down with grace when it's time to stop. These tracks are yours. Just click the link in the description. Hey, welcome back. Here at the Market Mamas podcast, I cover a wide range of topics, from the intricacies of day trading to mindset mastery and psychological growth, with the goal of the conversations being next level growth for all of us. My name is Becky, and I'm a US-based futures day trader from the Pacific Northwest. My trading experience includes trading stocks, options, crypto, and futures, with both trading a personal account as well as with prop funding companies. Over time, I found that I most enjoy the fast-paced world of intraday futures trading, so that is my primary day trading focus now. Thank you for joining me on the Market Mamas podcast today.
Hey guys, Becky from Market Mamas. Okay, I'm going to do it. I'm going to throw this episode out here. I don't teach technical analysis at Market Mamas at this time, but I gotta talk about this. It's one of my favorite subjects in trading. Okay, so we're going to talk all about FOMC today. This episode is titled How and Why I Trade FOMC. It's not a recommendation for anyone else to trade FOMC, but we know people do, right? There's zillions of contracts exchanged on that day, and so I just want to throw out there the way that I have developed and cultivated my system with it, and how I am careful with it and what I see, and how and why I choose to dabble in it. So let's do it, right? So FOMC, there is so much hype and attention around it. We all know about it. If you've been a trader longer than like a minute, and you have heard about FOMC day, and as an early trader, likely you have been advised to stay away. So I echo that. It's definitely something to be careful with because there's high volatility on that day. It happens about every 6 weeks, 8 times a year, and that is because on that day, there is outsized volatility compared with most days. So most days there's a reasonable range that each indice will move, and that can be anticipated as like a normal daily candle size. On FOMC days, during a short period of time, the last 2 hours of New York session, there will be increased volatility and larger than average moves, larger than average candles, and so then larger than average risk. So that's something that really has to be factored in when you're trading the situation. Higher volatility, it just requires higher risk to participate. In nearly all instances, that's the way that it works. Bigger movements equals bigger potential risk in the opposite direction. All candles are larger in this moment generally, and so then larger stops are required to stop at a greater distance from your entry price. It's a factor. So that's why it is often recommended by all mentors and trading communities to just avoid it, to watch, to see what happened later in the day, check it out, see how it moves, but protect your capital and your accounts, which totally makes sense. The potential opportunity, it's not always within a normal trader's risk tolerance, their style, or what they have learned, or especially an early trader wouldn't have the risk tolerance for that sort of volatility either. Okay, so then why do I trade it? Guilty. And let me explain, because it's kind of a complex answer. So first, and a little bit briefly, but I want to say what is FOMC in case not everyone is familiar with it. So Federal Open Market Committee, that's what FOMC stands for. They have a meeting 8 times a year, every 6 weeks. And the FOMC, it's for the United States, but it does impact global markets because the United States is, a big name in the stock market financial world. And so when our government changes interest rates, it impacts a lot of the stock market at the same time. So when they, at this meeting, they will announce any changes to the federal fund interest rates. And that is the rate that the Federal Reserve can lend at that rate to other financial institutions. So the trickle-down effect through our whole country is significant. oftentimes the actual rate change will leak ahead of time, whether it's going to change or stay stagnant. So that is not always a surprise on the given announcement day. Generally, it's anticipated, and almost always it's anticipated correctly. But the caveat to that anticipation is that during those sessions after the initial rate announcement, the federal chairman, currently Jerome Powell, will speak about the future intentions in the statement portion of the press conference. That generally is more impactful for the knowledge that is shared that day, because it will give kind of nuances to the financial situation for our government and intentions moving forward. And so sometimes that is the bigger bombshell than even just the rate. So it's interesting. The whole conference, it's important because it's indicative of the U.S. currency evaluation, and that does have a pretty big significant impact on the stock market momentum and direction to a certain extent, right? I mean, we've all seen many other things randomly have a large impact as well. So it's not the only thing by any means, but it is one known for having a larger impact in volatility. So then, if it's riskier, how and why do I trade it? Let me tell you. Okay, so initially, when I started learning trading, I was like, oh, I'm not going to do that. You said not to do that. I want to behave. I want to learn the right way. I didn't. But I was curious, right? I was curious about the hype. And so the first community that I was a part of will sometimes do live streams during that time. And so I would tune in and just hear and talk about it and be like, oh my God, look how big the candles are. You know, it was interesting. It was exciting. It was something novelty within the day-to-day stock market movement. But then I thought, I wonder if there's a way to trade this, right? It seems to have some patterns to it. So I started trading it just in eval accounts a couple years ago. And that kind of got me a taste for like the high momentum trading outcomes. Sure, there were losses, but if I'm only trading at one eval that I bought specifically on sale for this event, the sting wasn't bad. But the wins were like, oh, there's some potential here. I wonder if I can get better at this. And so it kind of gave me some information about how there's really a lot of opportunity in this, but you have to pay attention and figure it out. So as I'm doing this every 6 weeks when I'm not at the hospital working, sometimes I work Wednesdays. But if I'm home, I would trade it every time between 11 a.m. and 1 p.m. Pacific Standard Time. I live on the West Coast. I would see what I could do, what I could understand. I would start making notes. There was quite a while where I would trade the opening seconds. So as soon as it would start pumping, I would try to get in on that first move. And so I really just dabbled a lot for like a year. And I would make notes after every session, what the market was doing coming into that session, if it was bearish or bullish or consolidating, what happened intraday, what levels it seemed to respond to. And then I would just kind of start gathering the data, and I would trade every 6 months, even in the madness, and I would start to learn it. And it was just so interesting to me. I would read about it. I kept the leverage low for a long time, just in evals or sim initially, and then in one eval, and then a couple evals. But for me, what really changed it was the studying, the backtesting. That was a true key. So I started noticing in my notes there was some trends, there was some commonalities, certain things I would see time and time again. And so, from the early, like what's happening in the first seconds and can I partake of that? Is there a directional bias presenting in the movement? What happens when we are trading above or below the VWAP bands? What information does that give me? So pages and pages of notes. I'm not kidding. My doc on Google Docs is 22 pages to this day, and I've refined how I do that. And then pages of hand notes. So I really invested, I really invested in the work of trying to understand the stakes. It was interesting to me. So all that work before the sessions and then actively having skin in the game during the sessions by actively trading them, that's when the patterns really started to emerge in my mind and make me think about how and when is the best opportunities here. And so that's similar to any trade opportunity, really. When you're learning trading, you have to show up for that work. You have to study, and then you start to be able to see things quicker and more clearly. Patterns start to jump out at you more so. You realize there's an area of interest and what it looks like for that area to hold or that area to fold. And that will help you notice it sooner the next time you see it. So the variability at that 11 a.m. moment, that ended up not being it for me. It ended up annoying me more than anything. It was inconsistent with how long, how far it would push or fall at that given time. So it was quick, yes, which I wanted, but it was inconsistent for a win rate. So that was out for me. I stopped trading the 11 on the dot, momentum. And then the retest energy after it did the first push up or down, it was different. There was too much variability there too, in terms of if it immediately started falling, if it, in the case of initial push up, or if it held, there wasn't as much of a consistent opportunity there either with my retesting. So I didn't like that. But then I saw with a consistency now, probably consistently greater than 85% success rate, I found that there's a key pivot point with the price action between the times of 11:35 and 11:45 a.m. Pacific Standard Time. So just over half an hour into the meeting. Almost always, with the exception of a strong trending move that just didn't even catch her breath, just kept pushing up or down. Those days are exceptions. But most of the FOMCs, definitely most of them, would show me that there would be a retest in that time at 11:40, give or take 5 minutes, where we would hit a key level, it would be a retest, and then it would reject and it would go in the other direction. And so if I could understand, if I could study and if I could understand the market context coming into the FOMC, which direction are we generally heading, and where we're at intraday, as well as the larger time frames, then I could often kind of see the pivot level hitting and the response there and what might happen, and then I could get a sick entry. So this was often really very good for a large, longer move. It would happen fast, the candles would be large, and so the points would accumulate much quicker than a short session, or heaven forbid the afternoon Asian session madness that I cannot do. I lose when volatility is low because I don't have the patience for that. These trades would happen fast and large, which I was down for. So once I started seeing that, I did more backtesting. I went back through what I had backtested and I isolated those pivot points for years worth of FOMC days. I would find the time for the best opportunity in that chunk of time between 11:30 and 11:50. Was there a pivot? If so, what did that look like? What time? And the notes started to give me more reinforcement for this. So I started trading this trend early this year in 2025. Evals initially, and then performance accounts with real money, and then trade copied performance accounts the last handful of months here, where I'm putting all of my leverage on these trades. And it's going pretty well. By being super specific on this and defining it and studying it and having these patterns in my mind of what it looks like when it works, that allows me to have a defined risk management, which is key to trading this. You can't just throw money at this with wide open stops. That's not how I behave as a trader, and that's not the energy that I want to feed into. I need to be able to define my risk and have a pivot point that I am trading based off of, because I'm not ever willing to give up all of my accounts or my own capital for any trade opportunity. Even if it's like a fast, sick FOMC move, doesn't matter. It has to have a defined risk management. And so I would need to find a candle pattern at my pivot level that could provide that clearly defined location for which to place my stop loss. That was part of the contingency that I promised to myself and my closest people, that I would always honor that when I am trading this, because I know, we all know, it's higher risk, higher reward, but you have to be able to manage that risk, right? So for me, when I would be able to identify these potential pivot points, they're potential because you don't know until you know, then my trade plan would be to have my stop loss just be on the wick of that pivot that I'm trading with. And so then the size of contracts that I'm allowed to enter with would depend on how big the wick is, what good of an entry I get, because every time you add a contract, it adds risk. So that would be a factor when the trade would be setting up, if I could get in for 1, 2, or 3 contracts, what have you. So that concept, right? That's the same as most of my other risk management stop loss placements. I always want to identify a level that I'm trading off of, and then I put my protective stop on the other side of that, and that's part of my planned and studied trading system. And then it makes any trade opportunity, FOMC or otherwise, less scary when you can define the risk and say, this is my maximum loss on this trade, and this is my trade plan, and it works or it doesn't. I take this loss or I take greater wins. It's not as much of an unknown. It takes some of the fear and drama out of FOMC because it just makes it almost another opportunity, right? That's just it. I mean, trading, the more exposure we have, the more trades we've executed in similar conditions, the more familiar it can seem and the more steadily we can execute on it within said conditions. The more you have it in front of your face and you're looking with intention of learning and studying and gaining the information, the more those patterns will show up in your mind faster and you can see them sooner, and they're not quite as startling even when the candles are large. And so this FOMC became no different for me in that respect. It's just one of my setup. It's a unique opportunity every 6 weeks, but it's still one of my setups. I have backtested it many times over, and I fine-tune the strategy with time. And so once I was able to clearly see how to manage the risk, that's when I was able to finally take it with my performance master accounts, which is kind of great because it's like you put forth all of this effort. Like what I'm telling you is the actual real truth of how I have shown up for myself in this respect. And so by having all that effort to be able to actually make real money, it's like arriving somewhere. There's all these little steps in trading that you seek and achieve and keep pushing past. And it's pretty great. And so I want to tell you guys a little bit and show a couple of charts, but I do want the caveat to be that I don't teach technical analysis and trading at Market Mamas. I don't recommend entries or exits because I'm not a financial advisor. I don't have licensing for that. So I want to fully authentically talk to you guys about my trading and my experience as an evolving trader, but I want it to be with the caveat that do your own due diligence. And I'm just telling you my experience with this. And so as I have grown with this trading setup, it just kind of stood up to me as such a good example, though, of how we can each develop our niche as traders. And so maybe even after watching this episode, you're like, that's cool. She's crazy. I'm still not going to do that. I love that for us. But if it's something that you have studied and you want to know more about and you stumbled across this episode with Market Mamas because you're looking for information, I'm willing to share everything. I'm very open, honestly. So, I say as a trader, we all have to find the setups that speak to us. And then those are the ones that naturally we will get better at. The setups will start to come to us more clearly. We'll see them faster than other things because they speak to who we are and the type of trader we're turning into. And so then when you start to find things that speak to you, such as me with this opportunity, that's when we do the deep dive into that setup and we show up for the work and we can get better. So I don't want you guys to rely solely on what I've said here to start trading FOMC. Please don't. But if you feel motivated to build your own trading system around it, let's do it. Let's show up for yourself and how I show up for myself and be curious and hunt for the information so that we can grow. I'm an ER nurse. I've been a nurse for more than 19 years now, and I have a high fear threshold. So I often have to work to chill out and be a patient trader. Hesitation, it's not one of my core struggles. That's another reason why the excitement of trading FOMC kind of speaks to me personally. So, this whole thing has been a fun evolution. Okay. I love talking. Let me screen share and just show you the last two and how that has looked for me. Okay. So this is my screenshot with annotations of the trade that I took with the June FOMC opportunity. So this was, I think, June 18th. Yeah, you can see the date down here. I trade with Sierra charts, and my charts are very colorful. I have figured out over time how to refine my drawings and make them in a way that speaks to me. So this is actually a less colorful chart than what sometimes they get to be. So if you like a really clean chart, we all rock our best lives. But this is what my day looked like on that day. So these orange levels are the initial balance, the first hour of the session. And so this is where this candle right here is where this session opened for New York at 6:30 in the morning. So clearly we had a strong push up. We broke up and through this value area. This pink here is the value area, previous value area of the day before that we opened inside of, and along this red band is my VWAP band. So you open alongside the VWAP band and the naked point of control as evidenced by this dotted line here, which was the core most traded level of the previous day. And then inside value, we initially pushed down and then we pushed up. And so then we pushed up. We broke out of that value area high, which is this red line here, and into this supply zone. This orange level was a supply zone from a previous day. And so we pushed up deep inside of it, and then we hit the sellers. So all of this resistance, these dojis, this rejection, the stopping of momentum of the bulls, and then falling back in, shown that we broke down, right? So push above, fall back down, and then here VWAP was holding as resistance. And then see all the sideways action? This is what it can look like right before FOMC, is a lot of sideways, just sticking around waiting for the news. So don't get chopped up in that. This is actually good volatility for a morning of FOMC. Sometimes it's like really tight, just awful days to trade because it's so tight and your stops will get triggered on all ends. But this around VWAP messing around was clearly waiting for the information. So this is a 5-minute chart also. So this big sick move, that is the 11 a.m. candle. Big. So this is what I'm saying, right? Inconsistent. If you chase this sucker up, it opened down here. Here it opened. It shot up and then it fell back down and closed bearish. So if you chase that first push and you're not fast enough, like it came down and went through the opening of that 5 minutes, right? Okay, so the first 5-minute candle clearly had volatility, and then we started messing around VWAP again. And then we pushed up. And you see this, retesting this. So it's the value area high from the previous day, the value area that we're trading in. I'm a value area trader. And then the sellers that we already encountered, responsive sellers in this area before FOMC, right? So the first push also tagged them. There were sellers there. We slid up again. So this will be the third significant push into this resistance for this session. And clearly I'm watching for potential sellers. Now this pivot time right here is 11:44 is the time that we rejected there. This is a bullish candle. It pushed up and this wick started forming at 11:44 rejection, right? So what did I need to see to get in the trade? I got in one here in this push-up candle, anticipating this rejection, not sure how high it would go. And my stop was above this previous point. And if it blew up into it, it could go higher and I want to wait. So I got in for one contract and then it held. And so then when this one started breaking lower, I added, and then this ended up being my average price for my entry. So basically I built my position slowly. I had one contract at a time as my style. And then this was the pivot point that I was banking off of, which was within my realm of normal entry times for this trade based on that backtesting, right? Between 11:35 and 11:45 is the most likely. And so then now I'm in here for my average short entry. My stop was here when I had just had one contract, and then this broke and showed me the sellers. At that point, I tightened my stop to there because as I'm adding contracts, I'm adding leverage, so I have to snug my stop. So then I move it tighter and I put it out along the pivot point that I am now trading off of, because this candle started at 11:45 and started pushing. So with my back testing, like we could be done pushing, right? So I'm in and we're starting to fall. So where do I take it to? I ended up getting in with a couple of contracts. And so I had this previous month's settle price, which we're trading in the middle of the month, June 18th. And so this is a key monthly level that we had been dancing it around. And so that seemed like a potential pivot point. Plus here, there was buyers. We broke above and it held and it pushed higher. So I thought this level here that created these wicks could potentially hold. So I scaled out half of my position here with a limit exit buy to close order. And then my last contract I held for this naked point of control retest. And so that, like I said, is the point of control from the previous day, the 17th. And we did tag it at open. So technically it's not naked anymore. It's naked when it hasn't been traded in yet by New York session is how I read a naked point of control. And so was tagged at open, but it had never made it back down there yet. And so I thought if we're still falling, that's a potential secondary target, because sometimes it will tag it at the start of a session, push away, and then come back and retag it in the same session, because that was clearly an area of high interest the previous day. So that is how I made my choice on this naked point of control. On this day, if I had had another contract, I would have held for the value area low, because in value area trading, oftentimes they will go from coast to coast, from one end to the other. And so in this situation, obviously there was strong bullish momentum. But, I didn't. That was all the contracts I had, honestly. So that's kind of justification for where I got as well. But I am the type of person that with this sort of volatility, I'm not good enough to just respect my initial risk and hold the trade forever. My style is to pay myself along the way and to scale out and to, protect my accounts, especially when there's a higher volatility situation. So that's why I will often scale out my exits. I will lock something in at a good target with good profits, and then I will hold my runner. Now, in this situation with my stop loss, I did not leave it at this pivot. With this high momentum, this was strong bears. And so I think initially I moved it to break even, which would have been right along here. And then once I moved to break even, I can't remember, to be honest, this was 6 weeks ago, but I will either wait for the first half or contract to scale out, and then I will move it on the 5 minutes, but probably almost always I will snug it up based on 5-minute candle closes when I'm trying to catch a directional move. So in that case, you would move it to here and then you would move it to here, in which case in this situation that clearly worked well either way. But I don't leave my stop in the red once the trade starts off. I prefer to get one contract scaled out and then move my stop either to break even or into profit based on the 5-minute candle closing. So that's how I would have managed this trade. And there's a lot more nuances with trading. And like I said, I don't want to, spend forever digging into all the aspects of the things that I saw in this chart. But this is just one example of the pivot time and what it could look like. And so if you have a trading system, whether it's value areas or VWAP bands or what have you, there's so many, honestly. And I think that they all can be profitable if they speak to you and you understand them and you have spent the time learning them and figuring out how to maneuver within them. For me, this chart makes sense to me because it's got my VWAP bands and my value areas and my larger time frame support and resistance. And then I added to that my setting of the specific event and the time factor of when the bigger moves start to happen. And so that was initial push. It was faked out. The bears showed some dominance from this large time frame supply zone. Third time we tapped it, the bears were still there. That's my invite to join that move. Okay, so this is the one that happened just 2 days last week. I'm recording this in early August. So this was July 30th, the most recent FOMC, and I'm going to release this episode a couple days before the next one. So this was the most recent FOMC. Now this chart is a little bit busier. I tried to pare it down so it's easier to read, but I kind of wanted to leave the information on there so I could really tell you guys what I did, because why not? I'm doing this episode probably one time ever. So I'm just going to put it all in there. Okay. So same thing, Dow Jones Industrial Average is what I trade as YM, a 5-minute candlestick chart. So look at this little tiny candle. This was the 11 a.m. news, and that's what I'm telling you. It's so inconsistent, the 11 o'clock move, whether it's huge, whether it sustains, whether it's a large engulfing, or if it wicks or whatever it does. This is an example of an awful candle because it just effed around, right? But that was that candle. And so then I'm like, I try to not be at my office in the first 25 minutes of market open. And in fact, I was still at the grocery store this day. So I'm a very busy mom. So I ran to the grocery store because I knew I wouldn't want to be here and I was rushing home to put the food away. And then I got to my office around 11:20, 25, and I started watching. And so this one, you can see it had just been a really tight kind of wavy day. The VWAP bands were not expanded. We were again inside a previous day's value area. And so we were just messing around and not really moving. And so when it finally held view up, Matt danced around it, point of control from the previous day, and then it pushed up, it tagged this daily breach resistance. So this green thicker line and this green thicker line were important for me. I actually went over with my mentor earlier this day, the larger time frame levels and what they look like and why. And so on the daily chart, these two levels were key because it was based on a resistance breakthrough on the larger time frames and where exactly those levels are at on the chart. And so I put this one and this one on there based on those levels on that daily and 4-hour chart. And then this one I love because it was right in confluence with the value area high from the previous day. And I apologize, I made this chart after the fact. These all should say July 29th, July 29th, July 29th. I updated it. So these were the value area high, the naked point of control, and the value area low of the day before this day that we're trading, which was the 29th of July. And so we opened up and basically just oscillated within them and kept it tight all day before FOMC. So then FOMC started and we got this nice march up here. We tagged the daily breach resistance area that I identified with my mentor on the daily and 4-hour chart, as well as value area high that we tagged earlier. And there was clearly sellers that pushed it all the way back down. So in this New York session, we had a tag here with a strong seller response and then mess around and a retag here at FOMC. So automatically I'm like, this looks really good to sell based on my trade plan of this being pivot time. Now, this was an earlier one. My time frame is 11:35 to 11:45 is generally when it will pivot. Last month's June was at 44, so that was on the later side. This was 11:35 was the time that this wick kissed this daily breach level and then rejected. So this was early. So I thank goodness I was on my chart and I was focused, because when it pushed up again and it wicked and it started pushing bearish, this happened fast. So I'm like, it's go time. my risk is small because we're right here at the value area high, daily breach. So I short, get my contracts in up here. And then I'm like, okay, this is a small range day, small value area. How am I going to trade this? So I did this one in 2 parts, actually. So I took my first contract out at the naked point of control retag, which is VWAP, just to get some of the risk off the table. And then I held the other one to the LVA. This is a smaller value area, very low. This is a smaller value area than the previous day's example. And so it was way closer. Like this is still within the 2 bands of the standard deviation bands for this day's price action. The LVA very low was still inside of the -2 band. So high likely target that we would tag this. So that's where I had my 2 contracts out and out. So then I'm out of the trade here. I feel great about it. It was great points. But then I recognized that it was such a small day still, right? FOMC generally has more movements, bigger drama, bigger moves. So I'm watching it after I'm out and I'm like, I could be done. But look, you guys. Okay, so it pushed down lower. It did tag this daily buyer's breach. You can see that wick was just about there. And then it pushed back up. I'm like, But when it tagged VWAP, this was the candle broke through, pushed lower, and then we're coming back for it. And I like this time, the 11:35 to 11:45, as a stronger pivot point for the bigger move for the day versus the messing around in the first half an hour of FOMC. And so in my mind, I'm like, we really haven't done much still. VWAP bands are still tight. We haven't even done anything outside this value area. And to me, this shows bears are in charge. And this is a larger daily resistance level that we're falling out of. So when this pushed up, we tagged VWAP and the naked point of control again with the push up, and then it started turning bearish. I'm like, I can go again. So I shorted again. Right there, this is my second trade entry. And then where did I get out, right? And so this one already tagged the breach, pushed up. So this breach was a key level for me on the daily level and on the daily chart. And so I put my first contract out there just above it. And so that one sunk straight to it. And then the other one, look at this giant sell. I'm going to be honest with you guys. I don't prefer to sugarcoat or not be honest. I only took it to here. This gray area was an anomaly on a previous day, a low value, fair value gap. There was a 50% weekly level there, a composite area from previous session. There was a lot of areas that could bounce off here. And this was my second trade. I was well into profits. And so I put my second one out there and I was out and I was content. We had pushed below the -2 band. So part of me wants to leave these trades open-ended, especially for my runner, and then just one time frame down my stop loss based on, the 2, 3, or 5 minute candle closures. When there's this kind of volatility, I want to keep it a little tighter. And so I will often have a smaller time frame chart open to manage my risk in that situation. But to be honest, I just didn't this day. And this was a lot of points because these candles are very large compared to the other, candles within the day. And so this is another example just of the trade last week of, the pivot time being pretty effective. I just wanted to say, this is how I have traded this. And I think that with any opportunity with the stock market, you just have to figure out how you can read it, how you can understand it, what you need to study in order to figure out what the market is doing, what the information is telling you, what the momentum and the area she's pivoting off of, what kind of information that's telling you, and then how do you manage your risk? Because we can't always control the amount of profits. Like in none of these days that I trade FOMC am I thinking I want 500 points on this FOMC day. I'm not. I don't ever put a number on that. I just want to manage my risk and get as good an entry as I can within my system and then see what happens. And so when the trade is setting up and I get my entry and it starts to move, that's when I futz with my exits and I say, this is a good distance. This is a high likely target for the first tag, etc. And I will adjust. And I always bring my stop closer in order to not make a green day turn red. That's just the way that I am the most comfortable trading at this point in my trading career and the way that I choose to manage my risk because I want to lock in good points, but I also am not willing to give it all back. And there is some, high variability with FOMC, especially as there is with the first hour of opening New York session too. That's the second, that's a pretty high volatility move in a general trading day. Both the situations when you get larger candles, for me, I want to manage my risk openly, actively, purposefully, so that I'm protecting my accounts and not letting it go, really green and then really red. And so this won't speak to everyone. I shared a lot here, and so don't judge me too harshly. I don't show a ton of my charts just because everyone trades so differently, but this one I think is so interesting, and I kind of wanted to just throw it out there and say that maybe it speaks to you too. We're not meant to be clones. Like, day trading is amazing because, we really can learn how we see the market and how we can execute with her. And Miss Market is abundant. Like, there's opportunities all the time. Like, I could pull up these charts and we could talk about all kinds of things with the different levels and where they react. But that's, a long conversation, and these episodes are not meant to be forever. So if this is an area, FOMC trading, if it's something that you're seriously curious about, though, my best advice for sure, even beyond this little pivot point time that I kind of let you in on my secrets on, I would definitely say, if it's something you're serious about, to take notes from me if you choose, but also just on your own charts, on your own backtesting, on your own system with your levels that you're used to, with your indicators if you choose, how you see it, and then build upon that. And so you want to hunt and backtest the last 20 minimum episodes of these days, and then replay it in a replay situation so that your risk is not at all active, but you can kind of feel out how it moves, how fast they move, how hard it is, honestly, to get your fills when you're trying to get a contract in on something that is moving fast. Sometimes you have to just take a market entry or multiple tries with your limit entry, even just to get in. So replay will help you kind of feel out that volatility and how to trade with it. And you get a feel for the particular dance with Miss Market, which is FOMC. And so for me, I enjoy trading it, and I have leveled up to trading with real risk. But, starting with sim or one prop firm eval is a great way to start after you've done some replay and you've practiced there first, because that is what I did. Like, this is not something that I just turned on. Like, my mentor, my trading people will know that I've been talking about FOMC for years now. It moves fast, and when you're wrong, it hurts bad and it hurts fast, and it's like a whiplash, like it's a car accident in your accounts. Like, it's a hard hit quickly that will rock you. And if you're a person that succumbs to revenge trading or tilt, there's a high possibility with these high impact hard hits that it can really hit your emotions and you can do further damage. And so to be super cognizant of your risk management, if you're ever going to trade something with a higher known risk level, to be very cognizant of that. Like, for me, I allow one attempt at this trade because there's only one specific time that I trade this. Now, that last one, I literally told you I got in twice, but that's different because I traded my system. It worked. And then I waited for more data, and then I saw a secondary opportunity based on just the size of the value area, the size of the move so far, like multiple factors. But in both situations, I identified my risk as, responding from that daily level or responding from the VWAP retest. And that gave me a wick to place my stop loss on. And so every trade that you enter, this or otherwise, you have to always kind of have that identified very early in your trade, and ideally before you get in. So that way you can be really careful with it. It's not so much a stop loss as it is a protective stop, it protects you. So, don't always trade based on anyone's recommendations. Don't trade this based on my recommendations. But, if you are researching this, go for it and make the time, learn, study, take notes, practice before you risk your capital. And then, learn to swim with this particular stroke before you fully jump into that water, right? I'm a trader, and as it's one way for me that I choose to truly live. I'm not great at playing small. I really want to experience everything. And I think we only have this one life right now. And so when I discovered that I had an early left for FOMC, I was like, I think this can be learned, studied. I could figure out an edge with it. I figured out hard things in my life. Otherwise, I dove head first and I showed up for the work. It wasn't like without paying attention, right? And so, now I trade it rather successfully. And so that's kind of how this episode even came to be, because it has been something that I was passionate about. Clearly, you can hear it in my voice, Like, when you discover something, I think that life is meant to be experienced, to be lived, to throw your hat in the ring and go for something if it speaks to you. So I say, let's go, with intention and caution. But let's go, I'm not a financial advisor. Again, I'm not giving entry or exit info here. I'm just seeing what my experience and practice and research has shown. The conditions, of course, would change after this episode. Like, what if this is no longer a valid tip in 6 months because the conditions and the way that the our US government and the FOMC is able to make choices. There's some discussion about Jerome Powell right now. I mean, this could be null and void in, 1 week, this concept and skill. So I would say never take anything as a holy grail opportunity and just show up for the work of whatever you want to do and stay fluid with the market conditions and what works now, and knowing that it worked for the past year, maybe it won't work for the year moving forward. So just stay present, I think, and flexible with what you are doing and how you are learning, and not too certain on anything, because then that keeps you safe. But I did want to authentically tell you guys like who I am as a trader, how I am, how I've got to this point, and one little slice of how I trade. This is one little area, right? This is once every 6 weeks. But it is a part of my trading practice that I enjoy, and I've worked my butt off to make it profitable for myself. And that's the outcome, right? This is a way that I have worked hard, and now there's a financial reward for that effort. So let's do what the hell speaks to us and builds the life of our dreams. And I say, let's go. I wish you all happy, safe, abundant trading. And cheers to living this one life to the fullest and honoring our personalities and our unique gifts. Take care, everybody. Bye.